Wow, Andrew, what a horrible Treasury auction. What is going on? I'm seeing the 10-year Treasury just skyrocket 10 basis points within a couple of minutes. What in the world is this the beginning of a debt crisis?
I mean, I think this isn't the beginning. This is the coming to fruition of a debt crisis. We've known the debt crisis is there. I think a lot of the market is starting to realize it. So yeah, today we had a 20-year bond auction, and it did not go over very well. Bill Hagman rated it as a C minus, and I mean that's a very, very, very low rating and a very rare rating. So yeah, the 10-year Treasury has spiked up, and it's spiked up to a level that we're just on a precipice where we could break some serious levels of support that hasn't been broken, really going all the way back to February 12th, February 13th was the last time we've seen levels like this on the 10-year Treasury. There's a Fibonacci level, big word. Fibonacci level is basically a level of resistance that is set from where the market previously stopped. And we haven't broken above it. It has held this for quite some time, and that level is at 458.8. Right now on the 10-year Treasury, we are at 458.2. So we are, a hundredth of a percent away from that, but we have already seen it tick above that today. We our high for the day is at a 459.5. So we've already broken it. We have come back below it, but it wouldn't surprise me if we see another run at this before the end of the day.
So what's going on? I mean, let's dive into why this is happening, and I'm going to rewind real quick. So for those listening, you're interested in real estate, you're interested in housing, you're interested in mortgages, and this is really bad news. And so what has been going on these past couple weeks? I want to rewind all the way back to April 9th when Trump basically just said, "Hey, we're going to reverse our position or pause our position on tariffs." Why did he do that? It's because Scott Bessent, basically, who's the Treasury Secretary, he basically was like, "Hey, you like rates are going to start skyrocketing." They had a Treasury auction that day, and it didn't go well. Nobody showed up to buy Treasuries, basically, and he was like, "Okay, we have to do something," and that's when he did the 90-day pause. And then fast forward it to today, and we're starting to see stuff kind of unwind with the Bank of Japan and their yield starting to spike. We're starting to see people again pause on buying treasuries, and obviously that impacts the housing industry. Mortgage rates are starting to creep up. Andrew, I've seen mortgage rates go up from basically like 6.5% to over 7% just in a couple of weeks. I mean, that's pricing and pushing buyers on the sidelines, right?
Yeah, I mean, so obviously, any movement up in mortgage rates, we know home affordability is problematic as it is. At a 6% rate, affordability is still a problem. At a
Right.
6.5, it's a real problem. But I think there's something psychological about that 7% threshold. A six handle is a six handle. We saw interest rates for a long time over seven, at eight, and that psychological tick down to you can get a 6.75 or a 6.6 or a 6.5. It's psychologically a different world than when we start to see seven handles again. And that seven handle, we're seeing, I think it was a week over week, 5% drop off in mortgage applications, but that was prior to the 7%. Now, next week, I would expect another sharp fall off in mortgage applications. I know we're seeing it. I went from having my phone ring, and if I'm not going to sit here and blow roses and sunshine up anyone's rear end because it's not the truth. The phones aren't ringing off the wall, but the phone was ringing. And the past few days, it's become eerily quiet. And I think I've talked to a lot of really big producers. Yes, people are still buying and selling, but there is a massive slowdown once we see that 7% and once the news starts reporting that 7%.
Yeah, there's people who are just on the cusp of being able to afford and purchase a home. And when these rates go up, it sidelines all of those buyers, and they're just sitting and waiting unless they're able to get with a top agent and be able to negotiate basically $100,000 off of the price. I mean, we're looking at the numbers, Andrew, and we're seeing that prices in Jacksonville are between 31 to 40% above trend line, where it would be affordable for a person to buy a home versus to rent one. So I'll give you an example. One of my friends is out there. He was looking in E-Town to buy a house and buy a townhouse. It's 2 bedrooms, 2.5 bath for $400,000, which is just like a crazy amount of money at 7%. His mortgage rate altogether with his mortgage payment with interest and taxes and insurance would be $4,000. He can rent that same unit for $2,500. Why in the world would that person purchase? So I said, dude, wait a minute. Wait, if you're planning on selling this house or you need to transition from this house to the next 5 years, you may want to put a pause on this and rent for a little bit because the math is not math and it doesn't make sense. Let's either negotiate to the point where it absolutely does make financial sense to purchase, which maybe would be like a $3,000 payment. Because, obviously you're going to get mortgage interest deduction. There are a ton of benefits from home ownership, not just from a financial perspective, but like, let's look at the numbers. And so he walked away and we're waiting to go now purchase in November, December, where we expect that 400,000 will probably be 350 for the exact same unit. And getting with somebody who understands what is going on in the market today and how to play the game to maximize their savings is incredibly important.
Yeah, and I think buyers right now are, you guys see it as much as we do. Sellers are unrealistic. Like they think they can get a ton of money for their house right now, and I think sellers may just starting to be waking up and realizing that it is not just a buyer's market. It is all a buyer's market. But I also think buyers are just wildly unrealistic. I was speaking with a buyer this morning, and he wants to buy a $450,000 house, put 3.5% down, and he wants a mortgage payment, including taxes, insurance, PMI, everything, HOA, under $3,400 a month. And I'm like, that would be a wonderful scenario a year and a half to 2 years ago. In the market we're in today, you're not looking at that scenario. Sure, you may find the one home that has a brand new roof where you can get insurance for $175 a month and it hasn't been sold in 8 years and the taxes are super low. But guess what? A year from now, your taxes are going up. So I try to be super upfront and be very direct with people and be like, hey, yes, the taxes are low, but yes, the taxes are going to go up.
Right.
People need to become a little bit more aware of the scenario of what they're home shopping in right now. There is just not a lot of like gotcha deals out there. And sellers, I mean, I went out to two different open houses today. I was at an open house, new construction home, and we are talking 1,550 square feet for $585,000.
Oh my
And
God.
I'm like, beautiful home. I mean, it's an amazing property, but it doesn't have a pool.
Right.
It's got a parking pad, no garage. And I'm like, good luck. This is a tough market we're in right now, and sellers need to get realistic because if interest rates continue to creep up, and I can share a chart in a minute, we're at a unbelievably critical level in the mortgage-backed security market right now. This is a level that has been tested 6 times going back way back in time, and it's held. Today we broke it just for a brief moment. Now it's come back above that level. But if we break this level, we will see interest rates get a quarter to 3/8% worse, and we'll see that happen incredibly quickly.
So, Andrew, before we hop into your chart, I want to show you one of mine. All right. So let's look at this. Can you see my screen?
Yes, got it.
It says, "What do you do?" So this is from NEFAR Hot Sheet. And basically what it says is we have 883 new net listings this week. So to put that in perspective, we have about 12,000 active listings. This is just this week. So we've had 7.3% growth in active listings in 1 week. And this is terrifying because let me show you how to do this math on this. You take the new listings, right, the 2479, you add in the back on market. So those are properties that went under contract and fell through, which is a tremendous number. About a third of homes are actually falling through and coming back on the market. Then you subtract out the active under contract and the pending deals, and that's how you get to 883. And that is horrendous, first off, because we've had about that pace or worse for the last 2 months, which is why you see inventory skyrocketing. But it's not skyrocketing as much as you would think. And here's the reason why. We are seeing a record number of expired and canceled listings that are just not selling. And we know for sure, based on our study of history, that 60% of these listings that are canceled and expired will come back on the market in the next 90 days. And when we're looking at this time of year, we're in busy season. And once August starts and school starts, We know traditionally number of sales comes down by about 50%. We're going to have this influx of these expired and canceled listings coming back on the market, and it's going to be a glut of supply while we have dwindling demand. And so, my message to you, it's like you can see this, Katie. I see you laughing over there. You can
I have
see
the, dude, I have
how.
the analogy. Like right now we're playing musical chairs, but instead of like EDM music, we're playing musical chairs to Josh Groban, and it's going really slow. But in August, when the selling season, when the buying season slows dramatically, music stops. Like if you're a seller and you need to move your home right now, you need to move it before the 1st of August. And that needs to be priority number one. And that is going to be price reduction and creative, creative, creative.
Yeah, exactly. And so this is a really cool chart from Zillow. Just wanted to share this with you. You can see from 2000, the blue means the prices are going up, red means it's going down. You can see the prices just skyrocketed from 2000 all the way up basically to 2007, then started to go sideways. And it took 5 years for us to hit bottom, 6 years from 2007 to 2012. But this chart's really cool because it also shows you seasonality. If you have your house listed right now, you need to sell it by July. It needs to be under contract for sure with a rock star agent by July. If not, you could be holding it all the way through February until next year. And who knows how much inventory you'll be competing with or how much lower prices will be at that point. So, those sellers who are sitting on the sideline, you need to get realistic right now. Demand is dropping at the same time supply is coming on rapidly. The numbers on MLS that show 12,000 listings do not include the shadow inventory from all these builders, right? The builders do not list and actively promote every single listing that they have. There's a lot of stuff on the sidelines that's coming to fruition. And when you look at 2025 here, 2025, it's a weak year. And with the rate spiking today, I just see so many more buyers sitting on the sidelines, just scratching their head saying, I'm going to wait for this thing to crack and then I'm going to come back and purchase later. The motivation of buyers is slowing down to the point where it has to be a deal. I'm only going to buy if it's a deal where I think I'm not going to lose my shirt because they feel like it's the peak of the market and they can see the inventory popping up every single day.
Yeah, and you make a really good point about builders, and I think it's something that sellers need to be very, very aware of if they're in a market with strong construction around them. We have a market out where I live in the Panhandle, Crestview, Florida, for instance. Uh, D.R. Horton built a massive neighborhood. It sold out in 2018 to 2020. These homes are all mostly military families, so a lot of people went in at zero down. Well, in the last year, D.R. Horton has started a new community right next door. The homes in community one that have been sold out are about $400,000 homes. Well, D.R. Horton's building 425 to 450 in a new neighborhood right next door.
Yep.
All of a sudden, D.R. Horton's homes are not moving. So what do? They drop their prices 20%, 15%, 10%. And now they're selling brand new construction for 395 when people are trying to resell a home they bought in 2020 in a neighborhood that's underwater and they owe, they did a VA loan with a 3.3% funding fee on it. So they borrowed 400 plus 3.3%. They were out underwater on day one. And I went through there. They had 12 open houses one weekend. I went through all of these open houses. There was not a person in a single open house. And three of the 12 open houses I walked into, the seller was selling for less than they owe on the property because D.R. Horton dropping the price right next door. And if you're in an area where builders are building, you're dead right. There's a lot of shadow inventory, but don't mistake it for 1 second. A company as big as D.R. Horton, they see the market shift. They see this shift coming. They are going to list all of their inventory at once at a discount, and then they're going to incentivize the real estate agents with 6, 7, 8% commission if they sell their property. And you're going to see a complete stagnation of resales and everyone move to new construction. That's what we're seeing in some of these small communities, and it's completely pinching people.
We're seeing it too. Absolutely. So sellers, get realistic on these numbers and listen to your agent when they're showing you the data. It is worse than what they're telling you, and we have the data to back it up. So Andrew, to close this video out, show us the numbers
Yeah.
on the mortgage rates and what's going on behind the scenes, and then let's go ahead and rock out.
Yeah, I'm gonna dive into this, and it's actually perfect timing because the 10-year Treasury just ticked above the Fibonacci level of 4.588. So let me
Oh
share screen
no.
real quick. Yeah, this is the second time today we've been above it. Now, it's going to depend on whether we actually close above this. I want to just take a quick second and give kudos to MBS Highway. Barry Habib, he's one of the top housing economists. He's won the Crystal Ball Award 3 times. The guy's an absolute genius. This is his software that I pay a subscription for, and it's brilliant. What you're looking at here, this is a very confusing chart, but I'll just give some quick high levels on this. This horizontal black line here at 4.588 is a Fibonacci level. It's a Fibonacci level is set when the market previously stops here. You can see back here on April 11th, the market stopped right at that level and retraced itself. So it's set kind of an imaginary ceiling. And that ceiling is held. It was broken all the way back here in February 12th and February 13th, but we have just ticked above it. This line has held, and it's been a strong one. We've actually, the 454 line has really held. It held on May 14th. It held on May 15th. It held on May 19th. And we've broken above that today, and now we're above the 4.588. And you can see there's no more lines. There's no real stopping point all the way up to 4.8 on the 10-year. And that's really just because it's top of chart. But the scary piece of this puzzle, you can see we're holding right now. This is looking at the mortgage-backed security chart on the same line here. And we have a Fibonacci level also set, and it was set all the way back here on the February 12th again. And this level of 100.31. If we break below that, you can see that level held on February 12th. It held February 13th. That level held April 11th and 14th. It held May 19th. And it's holding today as of right now at 100.31. You can see up here. If we break below that, there is zero support on the mortgage-backed security all the way down to a 99.65. Now, that is a bunch of minutia that you don't understand, but I will tell you that is 65 basis points worse in pricing. Meaning, if you were offered an interest rate today, let's just easy math say you're getting a $1 million loan for easy math, and you are offered a 7% rate for that loan today. That might not be your rate, but let's just say that's what it is. If we would drop all the way down to this 99.65, and that would happen over the next 2, 3, 4 days, that $1 million loan for a 7% rate would cost you $6,500 in discount points to get that same exact interest rate. It is 0.65% of your loan amount to get the exact same interest rate. So when I talk basis points, today we're down 35 basis points. So just today, with the rate you were quoted yesterday versus the rate today on a $1 million loan costs you $3,500. If we would drop down to this 99.65, you would add an additional $6,500 to it. That is a 1 point change, 1% of your loan amount in cost, which could be in a very short order. So I think we're dancing on very, very fine ground right now. The 10-year Treasury has broken as of right now above 458.8. The mortgage-backed security coupon of 6% is holding line. But I will tell you, if the 10-year Treasury continues an upward trend, we will break this. Like, this is not strong enough to hold. And we actually just broke below it.
Well, it's
we just ticked under it again.
Yeah, it's
So
going to break, Andrew. I mean, right, because we had this tax proposal that they're talking about pushing through in the middle of the night that's going to add $4 trillion to the deficit, and people around the world are wondering, like, why would we lend to the United States? They're going to go broke. They keep spending all the money that they bring in. They're not raising enough revenue. They're not having austerity measures to cut things. I mean, the economy's starting to slow. Why would we lend to this country when they're just going to try to print their way out of it and devalue their dollar? And so people are selling out of their treasuries on top of the tariff issues that people, these other countries are upset with. I don't see how we reverse course at this point. I think rates are going higher. I think they're going to be higher, much higher in a year from now than they are today. I think the Federal Reserve is going to have to come in with like an emergency rate cut or a bunch of quantitative easing on mortgage-backed securities and treasuries. Otherwise, the housing game is over, the credit card game is over, the auto loan game is over, and we're going to start seeing a bunch of these bubbles pop. But if the other side of the coin, Andrew, is like if they do this and they do start raising, they're just kicking the can down the road and making the problem worse.
they are. And I mean, yesterday the Treasury bought the Fed bought
50 billion
of treasuries in one day, and we're still seeing it go up 11 basis points today. Like, you would think that would calm it. Yes, I think the only way we see mortgage rates like meaningfully come down is if we can actually enter a very deep recession. And the only way we actually enter a true recession is if the labor market cracks.
Correct.
If the
Yeah.
labor market remains strong, we will not go to recession. We are in for a pretty wild ride. Saving grace today, and this is not long term, but saving grace today would be if the 10-year Treasury closes under the 458.8. It would strengthen that ceiling. Every time we close, we break above it and end up closing under it, that ceiling gets stronger. So it could be a saving grace to us. But right now we're above it. And right now on the mortgage-backed security market, we're below that threshold. We could be in for a lot of pain over the next few days.
I shorted the market 2 days ago. I'm very happy with my short. I'm going to continue to short the market. Every piece of data that comes out is worse every single day, and I don't think the stock market's going to hold up. I know we had this massive rebound of 20% in 22 days. It's just, I think those are mostly retail buyers. The smart money's on the sidelines buying gold and crypto and finding other hedges because we think that the base case is that the Fed's going to come in and try to monetize everything and print our way out of this. And I think that the big investors in countries around the world can see that that would be a devalue of the USD, and they're trying to get out of US dollars as soon as possible. But we'll see. Andrew, great summary. Thank you. If you guys want to subscribe, go ahead and comment. What do you guys see out there on the ground in the housing market? Comment, subscribe. If you want to listen, if you want to get more information that I can't say on YouTube, go ahead and follow my Substack. I'll put the notes down in the link for my Substack. Think Big, Question Everything. And we'll see you guys soon. Thanks.
Take care.